This is an ugly market. What I think is going on here is there are two factors for the market to digest. One is inflation, and that created the market to set up in certain ways. Everyone's crowded into certain themes. Then growth starts evaporating. You can see it all over the place, stuff like consumer discretionary stocks. You can see it in the forward-looking indicators. And so the market has to deal with inflation plus growth. And what that's basically mean is everyone's hit the liquidate button. So everything's getting liquidated. This is the correlation of one style markets that I was warning about. And it hits everything from crypto to pretty much everything. And the thing that stands above all ends up being the dollar, because that is the kind of safe haven. Dollar today's had a slightly different day. We've corrected some of the move, but we've seen some huge moves in the dollar, and I'm not sure it's entirely done yet. So there is a massive liquidation going on as people struggle with their portfolios, because basically whatever position you've got, it's wrong. And that's the pain everyone's going to have to take for a while. So I think we're at an inflection point, and a lot of people don't agree with me. We are doing the transition from inflation to growth. The next shoe to drop will be the inflation shoe. I think inflation and growth go lower, and we either head into recession. Europe looks like it's already in recession. China has been essentially in recession for a while now, but maybe coming out the other side, early stage. And the US forward-looking indicators suggest, look, it's not clear it's a recession, but it's clear that the ISM is certainly headed to 50, or maybe just below, which is the ISM, the Institute of Supply Management Survey. Anything below 50 suggests that growth has stalled. Anything below 47 usually gives a recession. So we're getting in the phase where we're going to have a very slow patch, and there is no sign yet that that's turning around. So it could accelerate lower. So the recession is potentially on the cards. It's certainly on the cards in Europe. And we need to figure out, what does this even mean? What does it mean? And I think the big thing it means is bond yields are coming lower, because the inflation narrative, I think, is about to change. These kind of prices will lead to demand destruction. And I think that's what we're seeing. We're seeing commodities crowding out growth. And I'm also keeping an eye on crude oil to see how it trades. A lot of people have very bullish forecasts, but I'm worried that the demand situation is not quite as good. And if crude oil does break this pattern to the downside, and it's far to be proven yet, then the inflation narrative would disappear very quickly, because inflation expectations are basically driven by the oil price, bizarrely, as if that's not the only thing that drives inflation, but that's what drives inflation expectations. That would change the narrative a lot and drive the panic into bonds. So if you've got a falling equity market, falling growth, falling inflation, well, that drives everybody into the dollar and bonds. And, as people know, I love the dollar and bonds generally as a trade. That's the most macro trade of all. Oil either needs to break above 110, which it tried to do, and maybe even a bit higher than that, or if it breaks below 95, then I think it accelerates lower. So we're in a tight range. It's kind of, tender hooks, which way it goes. If oil breaks higher, it's only going to increase the demand destruction and the squeeze on corporate balance sheets and the squeeze on households. So it's not a good setup here either way. We've either done the damage already, or we're going to do some more damage. So it's, these are very important markets, and this is a very macro environment, and it's very, very important to understand what it is. Yeah. Now, if I'm right, and that the inflation story is going to change and growth is going to go slower, then we start shifting into a dynamic where we question what the central banks are going to be doing, and if bond yields are going to come lower, stuff that's been really beaten up, like the further end of the growthy stocks, they should be more interesting in that environment, because they got killed by inflation. I think gold does pretty well. It's, interesting enough, gold and growth stocks tend to do badly as real rates start tightening, but they got to zero and it looks like the world's falling apart, just as the central bank are trying to undertake quantitative tightening, or at least no QE. And if that's the case, then real rates are going negative again, if I'm right. And that's usually good for gold, crypto, long end of growth, that kind of stuff. and bad for everything that people have been in, like commodity stocks. Amazon is a really interesting story. People aren't paying attention. Amazon, the world's largest retailer, is saying they're overstaffed. They said it in their statement. They're overstaffed, and the year-on-year comparisons versus a strong year last year because of COVID is going to make them look bad. But the overstaffing element makes me think that there's layoffs to come. And I think there's broader layoffs to come because of this fall in consumption. Because if you think about it, last year, particularly in these kind of stocks, there was an enormous amount of staffing to deal with the excess demand. Well, that excess demand is now gone. And therefore, you're likely to see they're going to have to trim some of the staff. So, this is not a good setup. But in terms of equity markets, the average recession, and this doesn't feel like it's a financial crisis in the brewing. It feels like, I've been talking about for a while, that the business cycle is going to get shorter and slightly more violent as opposed to the long moderation period we've gone through since '87 or so. So if that's the case, then it could be a shorter, sharper clearing event. And the average kind of recession in that sees the equity market down between 20 and 30%. So I think we're getting closer to the bottom than the top. But who knows? Only time will tell. Maybe things develop that get uglier. The real economy seems to have slowed really fast. So, because what's happened is everybody built inventories because of supply backlogs, right? The right thing to do. Supply backlogs clear. Demand falls because of high commodity prices and inflation. Everyone's stuck with a whole bunch of inventories that need to be liquidated.
Yeah.
That's not good. And we're seeing the supply backlogs clear because, the Port of Long Beach in the US, much clearer now. We're seeing the same with freight traffic has gone negative year on year, suggesting that the economy may slow significantly forward. So those kind of indicators, restaurants, been weak. The consumer has offset some of this by credit. So we've seen them drawing down their savings. So the savings ratio has been collapsing. But consumer credit has held up. And that's what traditionally happens in the US. They balance off savings and credit. But if people start losing jobs, then all bets are off. Europe, different story here. Europe's between a rock and a hard place because of the reliance on Russian commodities, particularly on gas. And Europe's in the transition to ESG. That transition is going to take the best part of a decade before it really starts taking marginal demand away from fossil fuels. And they're steadfastly wanting to adhere to that, and I think it's the right thing to do, but they're going to have to take pain in the middle, and the pain is the economy. And what's happening is the outlet valve for that right now is the euro, which has been going down fast. We've seen the outlet valve in Japan being the yen going down fast, and we're starting to see the outlet valve in China being the RMB going down. Now, that's actually good. The rising dollar is bad in the short term because it creates funding problems, and it can slow growth significantly. But if these economies see cheaper currencies over time, it's going to create a larger deflationary wave because they're all exporting nations. So there's kind of the bad of the strong dollar and the good of the strong dollar all at play, but that's a phased thing. First, the dollar up fast is a bad thing. Then a weak set of global currencies helps them get traction and recover. I could see it in the economic data. I could see it in the positioning in the markets. I could see it in how things were trading, things like consumer discretionary versus consumer cyclicals, that kind of stuff. I could see it written large that we're going to get a slowdown. And so that's why I thought, okay, this is starting to get concerning. Now, I've been looking at this narrative developing for 9 months. Economies take a long time. There's only 9 data points. Now, I could have taken the commodity trade, but my time horizon and my secular framework means that I tend to err on the side of the disinflationary. So I would rather take the setup and wait for this bigger setup, which I think is coming. So, yeah, I mean, it so happened that the timing got spot on, but, I use a whole group of things from secular trends, business cycle, to technical analysis and flow of funds. Stop technology with a recession. What you do is you might stop consumer behavior. You might stop marginal dollars flowing into developing new projects.
Yeah.
But the technological adoption of whether it's robotics or AI or space or crypto or any of these genetics, that's not going away.
Yeah.
So even if they trade sideways, they become cheap over time because the network adoption keeps growing. Now, sure, recessions can slow these things somewhat. But yes, so
the stock can get whacked in the interim, of course, as we see.
Yes, and you need to use logarithmic charts and understand that these are volatile things. So use logarithmic charts, and I like the regression channels that I use, and you look for things like monthly log charts where they get 2 standard deviations oversold, things start to become interesting. So, as I said, the next shoe to drop for me is let's see what oil does. And then I'm starting to get very close to my DMARC indicator counts on bonds. So next week would be the weekly 9s and 13s all in place. But usually at the top of the chart of truth, the big 40-year trend channel where we've just broken out, I think it fails. And normally we get the monthly DMARC. That wouldn't be till June. So I'm thinking much like 2018, we kind of get this peak inflation fears, it starts dropping off, it kind of corrects a bit, and then maybe later in the year, the back end of the year, yields really start to fall as kind of people realize that both inflation and growth are disappearing.